Well, it's a strange market indeed. The US government has started its shutdown, and yet stock markets have powered into fresh all-time highs. We're going to try and interpret what's happening, but first, you do need to be aware that whatever I say is general advice only, and you have to consider whether it's appropriate for you. So the US government has shut down, and while, on the basis of logic, one might assume that would be negative for stock markets, we've seen the US market power further into fresh all-time highs. The S&P 500 index has closed higher for 7 straight sessions, 4 of those sessions, the last 4, being fresh all-time highs. What gives? Surely the government shutting down should trigger some selling, should trigger some concern. Well, perhaps one explanation we have for this is that perhaps investors were a bit cautious in the lead up to the shutdown, and now that it's happened, their caution appears, at least initially, unjustified. I think perhaps more likely, though, is that in the past the shutdowns tend to have been fairly short-term things, and the market has recovered fairly quickly afterwards. And so this time around, all the investors, all the algorithms, all the AI traders, everything is basically going, oh, last few times the market came back up, why am I going to sell now? It's just going to come back up like it did the last few times. Obviously, in the longer term, that's dangerous thinking, but in the short term, that's what's pushed the market up, I believe at least. And it probably will keep pushing it up a little bit further. US shares do look a little bit toppy though, and they will remain toppy and perhaps go even higher in price as long as they're expecting further rate cuts and as long as the US government is continuing to print more debt. Now, while this shutdown might affect spending in the short term, it won't affect the absolutely monumental levels of debt creation that their government is continuing to do. The government debt is currently about 7% of GDP that's per year, their government deficit. That is basically just a bunch of printed money, and with wealth inequality and the inequality of those cash flows being as severe as it is, it's flowing to the very largest corporations, the very wealthiest individuals, and they're pumping it straight back into risk asset prices. So it's not just stocks that are rising. Obviously, we've seen gold rise, we've seen other risk assets rise, Australian shares, foreign shares for US investors, and obviously the US dollar is falling as a result. So as long as those two things remain, which is the extreme US government deficit and the expected rate cutting cycle, things are likely to power higher. Those two things won't remain in place forever. One, inflation could threaten them, or two, an unsustainable debt spiral could threaten them as well. But until those two factors occur, most likely markets will in general continue higher. Things like the shutdown, yes, they might cause short-term volatility, and I would expect this shutdown would eventually cause some selling in markets. But for US shares at least, it probably won't be a longer-term downturn. Now, the longer that the shutdown does occur, the more likely it is to start to impact the real economy. I heard one estimate that said about 0.1% of GDP growth will be wiped out for each week that the government is shut down. I don't think the US equity market cares about GDP too much in the sort of short to medium term, but like I said, the longer that the shutdown happens, the more likely a bit of nerves will creep in, a bit of uncertainty will creep in, and some investors might decide to hit sell, and obviously that can snowball in the current market environment. For the Australian market, though, things are a little bit different. One, we're not seeing the same level of government printed money as much as the media tries to make it out. And then two, and perhaps the big difference is our RBA is a lot more responsible. They're not sort of as dovish, they're not indicating as many rate cuts as the US Federal Reserve, and they're sounding the alarm on inflation a little bit more than the US Federal Reserve is. In fact, at the last RBA meeting, if you didn't know they were in a rate cutting cycle, one could interpret their statement as suggesting the next rate move is higher. That really was quite a bit of a dampener, I think, for the Australian market. We didn't react too much at the time, but we perhaps should have. And the uncertainty about whether we're going to get more rate cuts this year, I think is a bit of a storm cloud hanging over Australian shares. So we've got our Australian government isn't printing as much money, our RBA is a bit more hawkish, but also our shares are operationally performing a lot worse. Our company earnings are terrible. We just had the August reporting season. and it was atrocious. There's no other word for it. Company earnings haven't risen in 3 years, yet Australian share prices have skyrocketed over that time. Really, there is a disconnect between the Australian share market and its current share prices, and the performance of the shares listed on the Australian stock market. Plenty of people have tried to explain it away, but the reality is it's just most likely foreign money, US money, looking for a home and pushing up our valuations. In terms of local information, though, that poor earnings season led to a pretty bad September. After our companies went ex-dividend, they really struggled to rise, and it was only continued US strength that eventually dragged us back up. If the US hadn't risen across the past few weeks, I suspect our market would have headed lower, and potentially a fair bit lower as well. That does leave us, I think, a little bit exposed should we see some selling in the US. I think we could see some downside in the Australian market. The next potential I believe big change for our market will come at the end of this month with the third quarter inflation numbers. If those inflation numbers come out perhaps slightly stronger than expected, that could rule out any rate cuts this year. Look for a number above about 2.8% as ruling out any rate cut, and about 2.6% or below as opening the door for a November cut. Regardless though, like I said, if US markets turn around, if we see some selling in US shares, I think our market will see some significant selling as well. So I will leave it at that for this week, before looking at the charts obviously, and that's the tug of war. The tug of war between pretty weak local conditions, pretty underwhelming conditions for Australian shares, poor operational performance, a bit of a hawkish RBA, and a pretty underwhelming local economy as well, to be honest. That's perhaps dragging us down or pulling us one way, perhaps to the downside. And then in the US, continued US strength, US government money printing, and the dovish Federal Reserve pulling us to the upside. It looked like, the tug lower was perhaps winning in in September, with the August reporting season fresh in our minds. And then as we've moved into October, perhaps the tug to the upside, with just unbelievable strength in US markets and other risk asset markets, helping to drag us a little bit higher. So our market, perhaps in a little bit of a balance point up at these levels. Will we break higher or will we break lower? One thing we can do is we can look at the charts and try and figure out which way we're going to go. This is the US market. They've been in a very strong uptrend since April. Recently, they pushed through 6,700 index points, this line here, on the S&P 500, and they've continued higher. 4 all-time high record closes, 7 closes in the green in a row, but their market does look extremely toppy. They will see some company earnings soon, beginning at the end of this week. Their shares are going to look very expensive relative to those earnings, but the earnings do continue to grow in the US, unlike here. Should we see a break below 6,700 and a break below that uptrend line, that's where we could see a move back towards 66 or even 6,500. It's hard to see them continuing too much higher in the short term, but stranger things have happened. Alright, and this is the Australian XJO index, and as we can see, we had a pretty underwhelming September where we fell off initially, and we really did try to go lower. And as I mentioned, I think it was only really the strength in US markets that stopped us from breaking below 87.50. We've held support at 87.50 or 87.40 roughly. We pushed up and then we broke through resistance at 88.90. We did that with the series of fresh all-time highs in the US after their shutdown commenced, their government shutdown. So we broke above 88.90 on this day here. We continued up to our own all-time high resistance at 9,000 points, and we held that resistance again. Should we hold that resistance and break lower, our first target would be 88.90 again. If that breaks, back to 87.50. Should we hold this short-term upwards movement, we would have to break above 90.20 for further gains to be confirmed. It's a little bit hard to say where we will go if we break 90.20, maybe 90.50, maybe 9100. It's hard to see us going too much further, at least after that poor earnings reporting season and with that more hawkish RBA. I can't really see us heading up through those levels unless, as I mentioned before, that Australian CPI reading at the end of the month comes in much weaker than expected. So I will wrap it up there for this week, guys, leaving us with a tug of war, strength in the US, local weakness. So far, the strength in the US is winning. It has won for the last 2 years since we started rising in October 2023. But nothing goes up forever. I've heard plenty of people tell me, this time is different. Well, history is filled with this times being different, and without fail, it never was. Hopefully you guys enjoyed. If you did, click like, click subscribe, and we'll see you guys next time.